Florida isn't crashing. That's exactly what makes today's message so dangerous for investors. There's no headline panic, no seismic wipeout, but underneath the surface, deal by deal, pressure is building. Now, today we're going to break down what's quietly cracking in the real estate here right now, who's feeling it first, and what serious investors are doing differently in 2026 to make a profit. This is no hype, just data. So economists and realtors say Florida housing market is stabilizing, not collapsing. That's true, but that doesn't mean there aren't some quiet stress points underneath the surface. The Florida Realtors Board reports the state market moving towards balance with rising inventory and price stabilization happening this year in 2026. But a stable headline hides deal-level pain points that traditional metrics don't catch. So this isn't a crash, it's a bleed, not a blow-up. Okay, let's start with the pieces that are actually cracking right now, not the ones you'll read about next year. So cash flow compressing on policy renewals for insurance and operating costs remains a significant factor for Florida properties, depending on the property. Are you looking at older homes that are in disrepair? Are you looking at larger homes next to the beach? Those are where your policy renewals could really hit you. Even as reform brings more carriers into the market, you got to watch out for certain properties. Something else to consider, appreciation expectations. They're moderating as they should be. Florida realtors and economists are describing a more balanced condition with less economic growth, which is causing less value growth in property values. So that means slower price increases. So if you're underwriting as an investor for too much of a appreciation, you're not doing yourself any justice. Couple that with mortgage rates. Those are still elevated, but man, are we seeing some very interesting things happen after Trump announced the $200 billion buy by Fannie and Freddie Mac of $200 billion being bought off the bond market. Just the talk of it has already dropped rates down for the first time, the lowest in 3 years, to the 5% range. So before, this was discouraging refinancing activity and locking owners in, but now it's starting to get to the point, even those people with the 3% rates might be willing to refinance out some of their equity and reactivate the market. It could be happening quicker than we know. And on top of all this, rental markets are shifting. Some national forecasts project slight rent declines in 2026. We've seen that the last 2 years in areas like Southwest Florida, where it was going up 10 to 30% a year. And then now they've had a 15% drawback in the last year and a half. We do see this starting to settle, but again, in certain areas, especially where rates are high for insurance and resaleability is not strong, you could see that rents continue to drop from desperate owners, something you want to watch for, and you don't want to catch that slow falling knife. Make sure the rental markets you're investing in have a stabilization, or you underwrite for at least a 10% reduction. Now, here's the trap that investors are walking right into. This is when the pain starts. It's not big explosions in value. It's that slow math that starts to decay over time. So what to look out for? Buying almost works deals. Those deals that are, they're so close on paper and it feels so good to say yes, but when you really look at the costs, you're in a holding pattern you should be and you want to move forward. Don't go with something that almost works. You're going to regret it 24 months from now. Also, relying on rent growth assumptions that are stalling or softening. If you're underwriting at a huge 10, 15, 20% rent growth to make things work over the next 2 years, don't do that. You're putting yourself in a really painful position. Also, calling break even long term without stress testing for slower rent or rising costs. Don't look for a break even. Again, and if you're not underwriting for certain rise in maintenance, repairs, including management, and also slowing rents or even a small reduction, then you're not looking long term. You're hoping for a quick roll of the dice to make something happen in a short amount of time. That's not how long-term buy and hold real estate works. And especially if you're building properties, you put yourself in these break evens, might work over long term. You could be stuck with a lot of inventory. And finally, you don't want to be assuming that refinancing is guaranteed. I mean, rates matter, and there has been this incredible drop. We're at the 3-year low, but where are these heading? What if Trump pulls away from these 200 billion in buying of the mortgage bonds? If that goes away and that was just a Trump tweet, well, that's going to put you in a situation where you better be ready that rates could jump up. So if you could lock in now under in the fives, great, but don't be underwriting for something several months out where you think that it's guaranteed or it may drop, because certain leveraged buyers out there too, they're stuck in their properties. They cannot refinance and getting the lower payments, which could continue to stall the market. This is a big one. If the market continues to shift downward for interest rates, that's great for refinances and purchases. But just remember, the mortgage announcement of buying back these bonds, which really is triggering this, has not happened. And we've seen President Trump tweet before and something not happen. So again, I hope it happens, but we have to be under the understanding it may not go through. So again, what I just talked about, those deals don't explode overnight, but they trap your capital slowly, give you stress, bleed you out as you don't sleep at night, and they're going to be building that market's fine in your head. And believe me, you don't want to be there. I've been there many years back holding a lot of property. And if you're investing or building now, don't put that slow stress to build up on you on top of your plate. Either stay on the sideline or underwrite a better deal. So who's going to get hurt first? Well, every cycle has its first victims. In 2026, I can tell you who's most exposed. First off, new investors that don't know what they're doing. They bought in the last 2 years. They have no management set up, no exit strategy, and they were underwriting either for a ridiculously high amount of short-term rental income, or they were underwriting for rents to go up 10, 20% a year from where they're at. They're going to get crushed. High leverage buyers with thin equity cushions. I learned this in the '08 meltdown. I would rather have half the amount of properties at way more high equity levels than to be closer to full value. Don't like to have high leverage in my debt. A lot of high leverage buyers out there might own a lot of property, but their equity cushions are so thin, something blows the wrong way, they're stuck in a very difficult situation. These people could get crushed. Also, anyone who's banking on rapid appreciation to offset costs. This is absolutely gambling and not investing. If, again, you hear people saying, I know this is going to go up 20% in the next 12 to 18 months, you know that they are rolling the dice. They might as well be in Vegas. Don't bank on rapid appreciation. If you're an investor or a builder, you should be looking long-term at the long-term fundamentals, and that incremental growth, well, that's what's stable and that's what normally sticks around. And finally, deal chasers that are influenced by social media metrics, not fundamentals. A lot of things seem good, especially when they're in a short video, but if you don't have the full functionality of the deal vetted out, how does it work from start to finish, from the type of property, how is it going to get financed, how is it going to get managed with proof of concept, with real metrics and testimonial, you could be chasing deals that seem really sexy from people that just talk about deals and don't even invest in them. So again, get influenced by fundamentals, not by hype in social media. So remember, if the market stops carrying you, the math shows up. Many buyers from the last 2 to 3 years are coming in with high leverage and cash flow stacks that they just did not estimate correctly. Those profiles, well, that's sensitive, and a minor rent or cost shift could really hurt them. You don't want to be one of those people, so do your numbers and be prudent with what they're actually saying to you. The smart, disciplined investors, what are they doing right now here in early 2026? They're re-underwriting everything from scratch, not assuming any prior comps or holds or any of the pie in the sky of the pandemic. They are really looking at exact numbers in today's market. And they're passing on 90% of the inventory out there. They're not looking at emotional properties that are highly priced above the median, or even properties more priced around the median if they don't really have strong fundamentals and cash flow off of day one. And also look for durability along with yield. yield. Some people will just look for a high rental yield, but the durability of the property, the long-term maintenance and repairs, extremely questionable. And your insurance costs will normally show that. These investors with the best experience, they're giving more focus to long-term stability, looking at buying a property and looking at 7 to 10 years, not 12 to 18 months to try to do a short-term flip or something. That's gambling. That's not durability. And you don't want to get stuck with properties you don't want to have long-term. And finally, if the math is unclear, you can't get a clear angle on what the rents are, what actual maintenance repairs are going to be, you can't get good insurance quotes, be patient. Step back. Don't invest if the numbers are unclear. So remember, sellers aren't always adjusting. They're waiting for that buyer to be undisciplined, step in and buy their property. You don't want to be that person. Remember, transactions, that activity is going to slow, which means volume is drying up. There could be a stack up. There will be deals in between those, but you really have to look at the numbers. Better to stay on the sidelines if you're just looking to add properties to your portfolio and just think it's all going to work out over the next 12 months. You should take action, but very disciplined, very reserved actions to make sure what you're putting on your plate is something you want to have for the long term. So again, you're going to see in certain areas, buyers pull back quietly, sellers have fewer takers, inventory will rise slower than demand shifts, and you have to, again, look between the lines on which market that's happening. There's going to be certain segments of the market, certain areas of Florida where it's going to happen more and more, other areas where it's going to start to stabilize. It's your job to figure out which ones those are. We're going to be talking about those. And again, do your numbers. You're not looking for marginal at closing. You don't want to get to the closing table and then have that buyer's remorse right before you sign off. That's a terrible feeling, something I've done years ago, not willing to do it anymore. So let's anchor into some data. You could make some bad decisions. You could really plant some great seeds. The Florida real estate stats are showing that the market should stabilize in 2026. Areas like Southwest Florida have already had a drop of anywhere from 20% in rents to 25% in values. That's a good size correction. And you got to keep in mind as well, permit levels are at an all-time low. That means all of the new construction builders out there pulled back on the new permits coming out. So it's going to take time as this COVID inventory continues to work out from 2024 through 2025, now into the beginning of this year. We're going to start to see a very large decrease in available properties. Even with new properties coming on the markets, as new people move in, there's not new construction properties that are through a big part of the cycle that are going to come out. That's going to make it pretty interesting and compete with people not being able to find properties once again. So all of these things with the likelihood of rates dropping, we know the fact that permits are behind, so a lot of new properties coming on the market is impossible basically for the next 2 years, at least new construction ones. None of that screams crash because those are supports to the market. But you want to speak and focus on a market where there aren't silly assumptions of rent growth or other things and refinancing. Well, that needs to be recalibrated. We see those rates drop. That brings a lot of money into the market, frees up money from other people coming from other areas to invest in Florida. It's super important. I think there's some stabilizing effects here, but you have to be careful of what can actually cause a crash and what will not. Okay, overall, I don't believe Florida's broken. Definitely a correction that went through the last 2 years, some drops in values in certain markets, drops in rents, insurance going up, but we are seeing a stabilizing and a sensibility of the numbers again. Again, I think it was Warren Buffett that said a house is worth what it can rent for, and if you're getting cash flow right off the bat, well, then that's a great sign for holding long term. So there are great fundamentals behind that as well with migration, job growth, and housing demands with almost 500,000 people coming here. So again, I don't believe Florida's broken, but quietly you have to piece together the deals. You know, investors who assume that they can just refinance, that rent growths are going to be 20, 30%, or, again, they're chasing yield in really questionable quality properties, that can be quite concerning and a trap to take all your money. So if you need some tools and checklists to help stress test what you're looking at, make sure you're not one of those overpaying foolish buyers that a seller's looking for, looking at what are the best terms to be getting, what are real interest rates, what's real insurance rates, comment below. Don't forget to like and subscribe, hit the bell so you never missed any of this objective research that I'm doing of what's really happening in the real estate market today, especially Florida. I'm Jim Sheils. Thanks for watching.